Good afternoon. Welcome to the afternoon session of the Online Platforms Market Inquiry. Late on a Friday, graveyard shift, and we have Mr. D with us. And I believe we have Kim Reid, the chairman, Mamachai Machlare, the CEO, and Alex Vos, the chief operating officer, if I have that correctly, and then I think you've got your legal representatives internally. Welcome to the Mr. D team.
Thanks, Mr. Hodge. Can you hear us okay?
We can hear you great, thank you. And at the outset, I just want to thank Mr. D for sending such a high-powered team from the business. I think we do appreciate that a lot, because obviously this is the team that has been driving the business, will have more insights than we would get from others, and we appreciate the time that the team has set aside. I know this is a busy time for the online platforms and the Takealot Group, so we're very happy with that. Mr. Reid, I believe you have a presentation, so I'm going to hand over to your team to share that and for your team to talk through that.
Great, we'll get going. See that up on your side?
All right, we can see that now, yes.
Right, okay,
Please
perfect.
Go ahead.
Perhaps just to start off, good afternoon, Mr. Hodge, Ms. Sepe, and the technical team and the general public at large. Perhaps to start off, just a few corrections to titles and things. I'm Kim Reid. I am the founder and chairman of the Takealot Group. We consist out of 3 businesses, which is takealot.com, superblis.com, and Mr. D Food. And Mr. D Food today is the applicable business that we're discussing. I'm assisted by Mamachai Machlare, who is the Takealot Group CEO. Mamachai joined us on the 1st of October, so a new entrant into our business. I'm very happy to have her on board. We've also got Alex Wurst, who's actually the Mr. D Food CEO. We've got Johannes Berger, who is our group head of legal and regulatory. And then we also have Tomosho Sekubela, who is our senior legal, regulatory and compliance manager. We're also joined around the table here today by our legal representatives, as well as our economists to assist us and assist the Commission in this process. They have been part of this process since the inception of the inquiry, since we have got involved. I think I'd like to just, because the at the request of the Commission, the Takealot hearing was postponed from Wednesday. I think it is important for me to raise just 2 issues. The first being the insinuation that the group has been uncooperative in this process. I'd like to say that we as a group, and you'll see this with the senior representation at this table, we welcome our opportunity to speak to the Commission and to contribute to this process. And we've spent a lot of time and resource and money and man hours over a very busy time to be able to reply to the Commission's requests, which we have done largely on time within their deadlines, and where we've requested extensions to those deadlines, we've then complied with those requests. It appears that the insinuation of us being uncooperative has come from a difference in legal opinion, which we would state that we're entitled to a difference in legal opinions. It is our constitutional right to actually differ in that regard. The second part to this is we've been accused of publicly, in fact, in this process of intimidation of certain parties that participate in our businesses. And I'd like to categorically deny any knowledge of any such intimidation within this process. Moving on to the next slide and introducing Mr. D Food. Mr. D Food is a proudly South African company. We have seen tremendous support throughout our 5 years of this business in its current form. And we have grown and contributed to the South African economy in various ways, partly by enabling businesses, which is the essence of our platform, and also creating meaningful opportunities for employment for many parts or many people who participate within our business. Perhaps a little history behind the business. Mr. Hodge, I think you're maybe of a similar age to me, so you'll remember Mr. Delivery. Mr. Delivery used to be what was today termed an old economy type business, which was really the ordering of food via a menu, which you would stick on your fridge. It would be delivered to your door by the franchisees, and was printed probably 3 or 4 times a year. And restaurants would pay to be advertised within the Mr. Delivery brochure, and a customer would then phone a telephone number to order from a variety of restaurants and have that food delivered to their door. We got involved in Mr. Delivery, as it was called then, in 2011 actually, where we made our first acquisition of a minority stake in Mr. Delivery. And really what the reason for our investment in Mr. Delivery at that stage was we saw a platform which was delivering food at night and had capacity during the day. And we needed a solution to delivering parcels to customers largely in takealot.com. And we then looked at this and thought, well, there was an opportunity to transform this business into a courier business as such, with this capacity that it had. We continued, however, with the traditional Mr. Delivery, or Mr. D Food as it's now known, business at that time, which was always our intent to look at how we could transform this business digitally. Then in 2000, we did various transactions with Mr. Delivery, which culminated in 2014, where the Takealot Group basically owned 100% of Mr. Delivery. In 2016, in fact, it was probably slightly before 2016 that we started looking at how we could actually transform this business into what has now become quite a traditional model for online food delivery around the world. It was a risky business at the time. We were basically taking on some large international players in the market, the likes of our competitors, which we can discuss later. Uber Eats and Order In. They were pretty much the only platforms that were around at that time who were operating on similar models, and they had launched slightly before us, I believe, in this digital format, and some had launched even earlier than this 2016 date. Worldwide, the model was still very much in its infancy and was not profitable. And in fact, today, many of these models remain unprofitable. Then in 2017, we launched what you see largely in Mr. D Food today, which is the logo and the look and feel of our app, and really the genesis of the business as it is today. Looking at the ecosystem that is our business and the participants in that, we have various participants. We have employees who work directly for Mr. D Food. We have franchisees who are contracted in and have businesses and build businesses on top of our business. And what they do is they facilitate through driver partners the delivery of food and other goods, in fact, to customers. And then, of course, we have the important outlets on the platform as well, and they contribute greatly to the value of the platform. And these are all important stakeholders within our business. If we look at something that we're actually very proud of, it's the employment opportunities that we've created over the last 5 or 6 years in this business. We've managed to create 12,200 driver partners, 565 franchisee employees who work for the 40-odd franchisees. It's important to note that of these franchisees, they're all SMEs, and 13 of the 40 are actually owned by historically disadvantaged individuals or groups. We have 526 Mr. D food employees, and then we service today 8,894 outlets who are all on the platform. These are the base numbers really that we can see on the slide, and obviously economically we can apply a multiplier effect to these numbers to get to the real benefit that the company that Mr. D Food has contributed to the South African economy to date. We're also an inclusive business, and we serve the majority of the country. We also serve inclusively several important areas for us as well, the likes of Alexandra and Athlone and Mbali and Johannesburg Central and Lenasia, Mitchell's Plain, Mamelodi, Phoenix, as well as Soweto. Going into the business itself and the model and how this actually works, let's start with the customer. The customer is one of the most important elements in our business. We are a customer-centric organization. We focus on the customer at all times. And really what this does is our business allows a customer to search through a variety of outlets on a mobile phone or on a computer. The predominant means of access to the business today is either via an Android or iOS application. And it allows the customer to either order for collect, which is a function where they'll actually go and order and then go and collect from the particular outlet, or they'll get something delivered to their door. We also develop tools and services to assist our outlets to come onto the platform. And all of the software that we produce here is produced by developers who sit in our offices today and develop the various tools and services that are required to actually operate on the platform. You'll see on the left-hand side there, that's an Android-based device that gets given to the outlets to enable them to manage their business through our platform. On the right, that's a picture of some of the information that we allow or we give to the outlet. They have free access to as much information as we can possibly give them, which allows them to actually manage their outlets on the platform. We try and improve these things all the time. It's important for us to provide tools and services to outlets because the greater value we provide to the outlet, the greater value we actually give to the platform, the greater value there is to the platform, the greater value there is to the customer. And this all feeds into each other to provide a valuable platform at the end of the day to the benefit of all on the platform and to those using the platform. If we look at the offering, I think the value in the offering is in its variety. And the more variety we have on the platform, the greater value there is to those who are on the platform. As mentioned before, we have 8,894 outlets who we service, and they all provide content into this platform that is then consumed by consumers as such, and have it either delivered or collect. Looking at the business model from how we work with the outlets and the benefits to the outlets, I think it's important to remember that we're only a very small percentage of any outlet's actual revenue today. An outlet has many means of getting to a customer, and ours is only one of many means that an outlet has to actually access a customer. And in fact, as I said today, we're a very small percentage of that total ability for that outlet to actually get to a customer. But what do we do for them? Well, we drive additional revenue streams. We one of the important things we do is we actually provide them with the ability to deliver to a customer. And that is no mean feat, especially at scale, to be able to provide the flexible driving supply to an outlet to enable them at peak times to be able to deliver to customers to fulfill the orders that are placed on the platform. We also provide them with reduced customer service fees and related interactions because we're able to get some efficiencies out of the model, which we can then pass on to them by being on the platform. Another important thing that they derive from the platform is access to customers. We market to customers and we bring people to the platform, and they then benefit from being on that platform because the customers that come to the platform essentially are then shopping on their outlets as such. We also provide marketing and advertising opportunities for them to be able to expose themselves more on the platform and to increase discovery for customers on the platform. Going into the business model and just a little bit on this flow of funds, a customer essentially pays in two ways. A customer pays the restaurant for their food, and they also pay a delivery fee as well. The amount that's paid for the food there's a commission that is earned by Mr. D Food. There's also a monthly subscription and activation fee that's earned by Mr. D Food, and there are advertising revenues if the outlet actually makes use of the advertising opportunities on the platform, which is also paid to Mr. D Food. Mr. D Food then pays out, amongst other things, to the delivery partners for the deliveries that they've actually made at that time. If you look at the overall breakdown of our revenue and where the majority of our revenue comes, it's important to understand that the majority of the revenue comes in the form of commissions. 75% of our revenues are earned through commissions, and those commissions are only paid if there's a successful order placed on the outlet on the platform. Another chunk of our revenue comes from delivery fees, which is actually paid by customers, and then a very small proportion of our revenue comes from things like advertising, which is roughly 2%, and subscription and activation fees, which is roughly 2% as well. Looking further into the Mr. D Food model, it's obviously critical to attract customers to or users to the platform to generate orders. We do this really through variety. So the more variety that is on the platform, the more it satisfies as users, because they can then find different things that they want to purchase on the platform. And essentially to create a credible platform, I think an important thing to understand is that you need brands, outlet brands on the platform, because the outlets in this part of the industry actually dominate the markets. And without these brands, it becomes very difficult to attract customers onto the platform. Now, having said that, variety is also very important. So you need both to give the variety to the user or the customer that comes to the platform. The brand, attracts, so it gives credibility to the platform, but that also assists the rest of the outlets that are on the platform, because they're assisted, because they have once the user is there, he's then going to search around and find something else and may discover something that he may not have discovered before, or something that he actually thought of. If we lose outlets or we push this model to the wrong way, basically the platform becomes less valuable. So again, citing reputable brands and small and independent outlets is vital to the existence of the platform. The other thing that's also important is promotion and discounting, because that brings people to the platform. This again is a new way of doing things effectively. So you need to convince people to come, and therefore you use promotional discounting to get them there. That's not the majority means of the marketing to this platform. In fact, as of this year, our latest numbers, if I look through the numbers, roughly 21% of our total marketing spend is spent on promotions. The rest is actually spent above the line in things like radio advertising, TV advertising, billboards, the various means of digital advertising as well to attract users to the platform. I think it's also important to note that in attracting the larger brands to the platform, they have many alternatives. They are larger organizations, and they can, do their own delivery if they wanted to. So we need to get them onto the platform and convince them to actually be on the platform. If we look at, I think a theme which is national versus local offerings. If you look at a national offering, which is ours, a national offering really it has greater risk and complexity and requires more capital. And I think it's important to understand that this capital is needed because the complexity requires greater capital. In building a national offering, your fixed overheads are higher, your engineering complexity is significant. And when I talk about engineering complexity, it really comes down to scaling. If you have a number of people, if you have 10 people that come to your app or to your site at one time, you can easily handle it. If you have 1,000 or 2,000 or 3,000 or 10,000 that come concurrently to your site, that becomes a significant engineering challenge. The other significant challenge as well is actually getting, the drivers and managing the driver pools at peak times as well. We find that on a Friday evening in our business, it's pretty manic. It's a peak time, and managing to actually service customer demand at that time is a challenge for us, and we have to put processes and procedures and spend money on both engineering and infrastructure to make sure that we can deliver a good customer service. In delivering a good customer service, we create value for the platform. In creating value for the platform, we create value for the outlets that are on the platform. And again, this all feeds into the loop that creates a sustainable business. Local offerings have less complexity, and they require less capital. You can spin up a local offering by using some outsourced software. You don't necessarily have the scaling issues to deal with. You don't have as many employees. You perhaps can find innovative ways to market your product. But having said that, you can still compete quite effectively with whether you're a local player against a national player. And we actually have a saying in our business, which has been really applicable to us as we've grown in a business, is that big does not necessarily beat small, but fast definitely beats slow. Look at how people discover things on the platform as such, on the apps. Sorry, I just want to have a slip here. We have various parts to our app screen, which we're showing here. The primary objective is to make sure that customers who come to the app actually discover something that they want. And then they convert and they pay the money, and that goes to our partners and it goes to ourselves, and it makes for a valuable platform. All of our listings, and I'll just use listings as a term right now, but I'll get into a little bit more detail in the next slides. This is all primarily based on location, and the location is about where the food is going to be delivered to. That is how we preface our listings, our merchandising, and even our search facilities. It's based on location and how far it is from the particular user who's just ordered ordered from the outlet. If we look at the next slide, you'll see that I'm talking about merchandise positions. We've got 3 merchandise positions on the app, and I just want to remind everyone that the way people use apps nowadays is they get onto the app and they flick through the app and up and down, and it's something that is fairly recognized and normal. in this environment. And these particular merchandised areas that we have on the app are all available to every single outlet that is on the platform. And it's also available at what we believe are affordable rates to those outlets. And they're publicized rates, so you can buy access to these outlets, to these merchandise spots. Having said that, many of these merchandise spots are not necessarily sold. This is an evolving business, an evolving platform, and we're looking at ways as to how we can improve this with the sole aim of improving discovery on the platform. So we want people to be able to find what they want as quickly as they possibly can. And so we use a lot of the unsold inventory that sits in our merchandise environment for the benefit of the outlets to aid discovery. The other part that we have on the app are what we call search and filters, and these are basic search and filters to, again, aid the user to be able to get to the outlet that they want as quickly as possible, or to find variety. So you'll find that they either search in the top box for pizza or burger or whatever they're looking for there, and they then get a listing, which I'll discuss just now, or they go through and they filter through these scrollable icons, which are on the special or favorites. We have a halal button as well, which just aids again in discovery on the platform. Just below that, you'll see what we term just food types. If I'm looking for a burger, it'll show all burger joints which are close to me, pizza joints or close to me, or Asian food close to me. Really, again, looking to aid the consumer in finding what he's looking for on the platform. And then last, and probably most importantly, is the listings part, which is the general part, which you get to if you search or you filter or you just scroll up on the app. And all outlets are available to customers based on their location here, and they're listed from closest to the customer to furthest from the customer. And the only caveat here is that we prioritize, to our detriment, actually to a business detriment, but I'll get into that now, delivery, those outlets that have made themselves available for delivery and collect versus those outlets that have just made themselves available for collect. We actually earn a greater margin out of the collect part of the business than we do out of the delivery part of the business. But this is good for customers because they're largely looking for people to deliver to their home or work or whatever that location that they've chosen. Our relationships with our outlets are extremely important, and they are governed by agreements which are really individually negotiated with each outlet or outlet group. We have no real power to seek exclusivities. Having said that, we have got two exclusive deals on the platform, but those are the only two exclusive deals. One's with a liquor outlet, and the other one is with an independent restaurant. I think it's important to understand that outlets price independently on the platform, and that we try and provide as much information to these outlets for free. And I think I've already said this, but we try and develop out these tools and services, because the more tools and services we can actually provide to the outlets to actually enable them to manage themselves on the platform, the better it is for the outlet and the better it is for us. And that's serving obviously these 8,894 outlets. Again, I think it's important to note that our percentage of revenue earned by outlets as such is a small percentage of their total revenue that they earn, given that they have so many other channels to go through. Again, proving or just how important our outlets are. We went into COVID lockdown, and obviously COVID lockdown was a difficult time for all. I think we all went into the space where Certainly in the first month, nobody knew what was going on, and nobody knew which way this was going to go for any business, and we suffered just as greatly. And then we were allowed to start trading in May 2020. At the same time, what we did when you probably found a greater reliance on of these outlets, although they have, they had many other means to actually get to market even during the COVID side. They had a greater reliance on us at that time, and we actually implemented a commission fee cap at that time, which we did to the majority of our outlets in lockdown level 4. And why lockdown level 4? Well, it was on delivery at that stage. It was the delivery fee cap that we implemented. If you recall, in level 4, only deliveries were allowed. There were no takeouts allowed. And then when they later toned down the lockdown levels to level 3, we then also, in addition, put in a collection commission cap at that time to assist the outlets. And why would we do that? Well, because we want them to survive. The outlets are vitally important to the platform, and the better they do on the platform, or the better they do in their businesses, the better we do as a platform at the end of the day. We also, during the riots and the looting that happened recently in July 2021, we also waived our subscription fees as well for all outlets in KwaZulu-Natal, to try and assist them to keep their heads above water and to continue trading over what was really an unusual period. The other part to our business and partner to our business is obviously our relationship with our drivers. And we have 12,200 drivers who we try and employ as many drivers as we possibly can. And this is an ongoing challenge for us to find the drivers to actually drive for us. And we try and look after the driver partners as much as we possibly can. And by way of example, during the height of lockdown, when driver partners could not drive, because I think of our driver partners, there were roughly only 400 who could actually work at that time, because of the demand that was happening in the early parts of this, and certain of them got COVID and were affected by COVID as such, not allowing them to work. We implemented this COVID driver fund, in which we actually paid out 13.8 million rand to drivers to assist them to keep their heads above water at this time. You may ask, why do we do that? Well, number one, they're our partners, and they are important to the platform, because without drivers, we don't have the platform, and we don't have the value in the platform. And if we hadn't assisted them at that time, and they didn't come back to us post, in what is now a much more normalized world, everyone would suffer on the platform. Not only the platform itself, but the outlets on the platform as well would also suffer. We also keep them safe. They're issued with safety vests. We subsidize although I must say, I suppose incorrectly so, we shouldn't have put this driver without a helmet on his bike. But we subsidize helmets for our driver partners. When we look at, we monitor weather situations and times of stress in the environment. And when the weather situation is bad and it's just not possible and not safe for drivers to be on the road, then we actually shut down those delivery areas, and we don't allow them to deliver for their own safety at that time. We facilitate, all of these things we facilitate access to for our driver partners. The other things that we facilitate as well is we try and facilitate entry and participation in the system, and we do this through various things. We assist with providing them or facilitating access to things like insurance offerings. We're looking actually at assisting them with defensive driving courses right now. We have already implemented schemes where drivers are able to access affordable motorbike lease schemes that enables them to drive, as well as the associated maintenance plans as well, which also allows them to maintain their vehicles, so they continue to work for the platform and for the benefits of the platform, and obviously for the benefit of themselves and the multiplier of people that they support as well. You'll see a Fair Work logo at the bottom of the slide. Fair Work is a independent organization that does a report every year. Alex, it's every year?
It's annually, yes.
Yeah. So it's done every year, and it really is a look at, they survey all of the gig economy as they call it, and this is a score that we got out of 10, 7 out of 10, which relates to how we treat our driver partners within the network. And this is a global score. And if you look at our score against any of the global competitors in not only in South Africa but around the world today, this score is probably one of the best scores that you can find in this report. Looking specifically to competitor dynamics and competitors, we believe certainly, and we experience this on an ongoing basis, that we participate in a very dynamic market and a highly competitive market. And when we look at competitor constraints and what affects us, it really starts with the consumer, and the statement that the consumer starts with is, well, I'm hungry. There may be a context to that hunger. It may be a party. It may just be dinner tonight. It may be friends coming over. It may be wanting to go out with friends. But it really results in various options that they can then choose. And if it's something like my household, these all compete with each other on an ongoing basis. And are we going to cook at home today and buy groceries? Are we going to go and sit down at a restaurant and have a meal? Are we going to get takeout tonight? Or for lunch or whatever that is, or am I going to actually get it delivered? And we obviously participate in two parts of this, which is on the delivery and on the collect side. Looking more specifically at competitors as such, we believe that the competitors are wide, and it starts off with, and this is in no particular order, but it starts off with national food chains and local outlets. They also have their own delivery services. Be that online, through apps, through call centers, through WhatsApps, through many different means. They provide delivery of their products to the consumer, and we actually deliver and have agreements with some of these as well. So we compete directly with them through their own services as well. If you look at sit down, we compete with the sit down restaurants as well. Many of them also have their own delivery services, but when that question comes and I'm hungry, I have the choice to go and sit down and eat a meal at a restaurant, or have it delivered to my home, or cook it at home for that matter. Then we've got the third party operators, people like Bolt, Uber Eats, Quench. You've heard from certain of these people already in this inquiry, and then there's potential competitors as well, which are coming in or already in the market. DD already in the rideshare side. They've already entered the market on the rideshare side, and no doubt that they will expand into food delivery as they've done elsewhere in their markets around the world. Then we have grocery retailers. As per my example before, I can go and buy groceries and cook them at home. And then we have the adjacent markets, things like the 60/60 development, Pick and Pay ASAP, Avo, which is a bank, which effectively is now delivering groceries as well. We've got Woolies is doing stuff, and then we've got Dis-Chem as well as delivering medicine that we also deliver as an outlet. So we have a large number of competitors and competitor constraints. In conclusion, we believe that the use of e-commerce as a channel is only just starting in this country. Having been involved with it since before 2010, actually. We're just starting to see some glimmers of hope in e-commerce, with e-commerce now sitting at roughly 2.3% of total retail. We believe this channel is dynamic and competitive. It certainly enhances consumer welfare. A great thing about this is it enables small to medium enterprise participation and growth. And if you look at our platform today, the vast majority of the participants on our platform, from driver partners to franchisees to many of the outlets, are all small to medium enterprises. And it allows and offers businesses the ability to disrupt inefficiencies. When we look at regulating this industry, and really, when we talk about regulation, in our mind, we're talking about an overly interventionist approach. We believe that an overly interventionist approach would actually be harmful to the growth of the sector, especially if it were to curb any growth of what we believe are efficient disruptors in the system and effective firms. This type of intervention would result in the loss of existing efficiencies. And these efficiencies effectively benefit both consumers and business users, and create opportunity and employment. And again, the undue intervention would actually disincentivize people and firms from taking risks, which is so important in our economy today, for people to take the risks and take bold risks to build businesses, make the investments necessary to enter markets and disrupt existing incumbents. And that'll allow improved platforms and improved consumer behavior, consumer choice, and better pricing and more efficiencies that come into the market. I want to thank you for the opportunity to be able to present here today. And we look forward to the Q&A session, which I assume will begin now.
Thank you, Mr. Reid, and you can stop sharing the screen.
There we go.
Great, thank you for the presentation, and I'm sure the public has also benefited from that information as well. I just wanted to start with your business model. And one of your slides, you mentioned that there were you put out 4 elements. So the one was signing up well-known, reputable brands, and as I understood, they're popular brands, and that's why it's important to have them on your platform. The other was small independent outlets, and as I understood, that was the variety element that you said is important in a platform. Consumers want choice and variety. Is that right?
Well, I think they both create variety. So it's not just the one, because brands give variety as well.
Yeah, look, I think they do. There's probably a lot more variety from adding the small independents, just in terms of cuisine types. But there are varieties of burgers and chicken and pizzas, I suppose, from national brands.
Absolutely. There are also national brands which are Asian businesses. There are many varieties sitting in the national brands, and I think one of the things we must be cognizant of is that the consumer finds the brands very important on the platform.
And then you've got promotional discounting. So that, as I understand it, the promos that a consumer like myself might get emailed on a weekly basis, or might be for new users, an initial discount. So it's a promo code you put into the app and then get a discount. Is that right?
That's promotion, yes. So it's free delivery. It's trying to attract people into the platform.
Then, of course, marketing investment, and you said that's all your above the line: radio, digital, television, etc.
Yeah, so and obviously, yeah, so digital, not really termed above the line, but yes, the digital side of things as well as PR, etc.
And when we look at this, I suppose, platform, the whole point of promotional marketing is to get the consumer there. I mean, that's as you indicated, the role, attracting the consumer, getting them to try out your delivery service. I mean, the one aspect that I didn't see here that I thought was also important is delivery fees. That delivery fees are discounted to consumers in also to make delivery attractive. Is that not right?
I think that delivery fees are important components of the platform. That is right. Remember that the promotional components actually discounts the delivery fee as such, but the delivery fee, the standard delivery fee, is an important part of the model as well. Yes.
But I mean, from our interactions, at least with this industry, I get the sense that the actual cost of delivery is in the sort of 35 Rand. But when I use the Mr. D app, at least I'm going to be charged 9 Rand. So you would absorb the rest.
Well, you actually won't be charged necessarily 9 Rand. It'll depend on where you are. You'll be charged a range, but let's call it 9 Rand. And the differential between what the cost is, which I'm sure we've claimed is confidential and we won't discuss here. That differential is absorbed by the business. Yes.
Yeah, and I'm not. I don't need your cost. Obviously, yours may differ, but I'm just saying this is what seems to be coming through from industry, and I suppose delivery must be one of your bigger costs. I mean, just thinking the actual transaction because it's involving drivers, bikes, um, whereas the other actual transactional costs might be credit card fees or the like. So just looking outside of the bigger platform development and fixed costs.
Part of look, I actually haven't got the actual exact percentage in mind, but apart from the fixed overheads and that the delivery fee is the amount that we absorb is a cost within our business, and it is a large cost within our business. Yes.
So as I understand, I suppose the Mr. D journey, um, just from looking at some of the interviews you've done over the years, I mean, funding is an important role, and we heard last week your parent company also indicate one of the value adds they provide to the businesses is funding. But funding can drive the promotions, marketing spend, delivery, lower delivery fees, and allow you to make a loss in the short term in order to drive growth for the long term. So that appears to be the sort of strategy at the moment.
Um, no. So perhaps if we look at our journey, let's have a look at our journey. So we've started out this business, and whichever business we've built to date, we've built it because we want to create a sustainable business. And in fact, I think in any interview that you've ever seen in the press where I've talked about our business, we always talk about sustainability. When we started this business, we actually didn't have funding from the likes of our current shareholder. We had an American investor who invested some money. I personally put in some other money as well into this business to start this business. And we developed it together. And it was only after we had actually ticked off certain proof points. In fact, and those proof points really come around the ability to execute in the market. Did our American investor decide to invest additional money for us to be able to expand our business? Post them getting out of our business in 2014, roughly, late 2014, and our new shareholder coming in, becoming the majority shareholder. The business plans have factually not necessarily changed since the early days, and the one thing that you may also see in certainly in the NASPAS financials and some of the reports as well is what we're known for in our business is a drumbeat of ticking boxes to get to these sustainability measures. So when you build national platforms, it requires capital. We can't get away from that. But it's not a unending pit of capital that we can just dip into, because that makes no sense. It certainly makes no sense for me and many of the management and employees within this business who are invested in the business, who derive their value from sustainability within the business.
And I'll come to that. I mean, in the long run, you've got to be sustainable, and we heard that last week from your majority sole shareholder, that it's not a bottomless pit. But I mean, looking at least 2019 interviews, I mean, you were talking about the whole Take-A-Lot group weren't at break-even point, and the different businesses were at different stages. Take-A-Lot will break even first, then will come Superbalist, and then you've got Mr. D. And in that, there was a question to you of how fast and how big you want to grow, Mr. D. And you said Mr. D Food, from the market share point of view, is the largest today in online delivery. Focus is on food delivery, and we will grow it and grow it aggressively. So we're in an aggressive growth phase to build scale. You obviously got to have an eye at one stage to the end goal of being sustainable. But I mean, from what I can see from low delivery fees, etc., I mean, this is an aggressive phase, and maybe COVID has assisted in that.
COVID has certainly assisted in the growth of the business, and I've heard and listened to some of the other participants on the panel who have talked to even some issues over COVID from scaling, which was difficult for this business to handle. But when we look at the growth in this business, I'll reiterate again. When we look at the businesses and the three different businesses, they're on different. They're at different starting points. Essentially, if you look at Take-A-Lot and Superbalist being what is today traditional e-commerce. The models are fairly normal and they're out there. There's certain things that you do and should do to grow your businesses. In a food delivery business like Mr. D Food today, the model's fairly new, and people are trying different things at different times. And again, we're a national business. We've invested quite a bit of capital into the business, and this is not in promotion or anything else. It's in platform and all the rest of that, and allowing us to scale. And we need to be able to grow to survive.
Yeah, and I suppose, I mean, all I'm putting to you is that you're obviously using funding to grow. I mean, it's not a controversial statement, but you're looking to scale, and funding helps because it allows you to drive more customer acquisition, which gives you scale, and obviously that also has implications for your infrastructure that needs to support that. Because if you stop delivering fast, as you put it, you might lose.
Correct, and I don't think that's unnatural. Funding is important to scaling any national platform, and if you look at the platforms around the world, you'll see that as well. Although I do think that our business does so in an efficient and sustainable way.
And I mean, to your point about trying different things, I was interested last week. We had the pleasure of Mr. Sylvester John, who was former Walmart and now at Massmart, and he was talking obviously grocery delivery in the Walmart context in the US. But it was interesting listening to him that how firms backed by, or aggregators backed by venture capital, the kind of business model is fund discounts to the consumer, fund delivery, and you bring the consumers with you. And at that point, even businesses like Walmart felt they needed to be on these platforms, in part because it's where customers are. And that's a sort of role that funding can play.
Difficult for me to speak to other businesses. I can speak to our own business and our own experience, having gone through Takealot and building Takealot and building Superblist and now building Mr. D Food, as I said, at the different stages that are in the business. You learn some lessons. And one of the lessons and one of our values in our company is to spend money wisely, and we try and do that at all times. So again, I can only reiterate, does funding help? Absolutely. I'd rather have money than not have money to build a business. Not having money to build a business becomes very, very difficult. But when you spend in the right areas, and you spend to build value, and you spend to build sustainability.
Yeah, I mean, I agree with you. I think the only point I wanted to make was, it seems not that much different in the delivery, and I won't get into obviously the e-commerce, because we will deal with that on the 24th. But in essence, you can put a lot of money into customer acquisition, and that may be promotions, it may be delivery fees, but I'm seeing a similar model, of that's how you acquire the customer. Once you've got the customer, I mean, then as you put it, the restaurants really have to be on your platform, because if the customer's buying on your platform, if you're not there, you're not part of the decision. And so that's why the restaurants will come. If you have the customer, the restaurants will come.
No, so I actually don't agree with that statement. So first of all, the restaurants need to be there to actually get the customers. That's number one. Number two, the outlets don't have to be on our platform. There seems to be this, and I think it's driven by COVID and what's happened, for a period of 3 months or 4 months, where restaurants found it difficult to find channels to market, and they had to reinvent themselves and do all the things. And we were fortunately there to help many of them. But the fact is today is that as a percentage, and I don't know the percentage, the actual percentage that sits, that we contribute to each individual restaurant, but I would be surprised if Mr. D Food contributes, more than 10% to any restaurant's actual total revenue, because they are doing sit-down meals, they're doing takeout meals, many of them are doing their own deliveries. So, the categorization that outlets have to be on the platform because we've spent to get customers doesn't work that way in my experience.
Well, we at least had the pleasure of listening to some of the restaurants as well, and even national chains are telling us that there's a degree of dependency on your platform.
Yeah, I'm afraid I didn't hear those, and I can't speak for the national chains. They have to speak for themselves. And if you've verified those numbers, then I can't argue with them.
But I'm just putting it as a matter of logic. Not everyone necessarily has to come, but if you own a few million customers, and what are your monthly orders? You don't have to give me the exact number. That's probably a trade secret. But are we talking millions of monthly orders?
No, we're approximating that, yes. But I think, sorry, just if I may, I know I'm interrupting what I think is your question, or perhaps you've already posed it, but we don't own any customers. I think one of the things that's so interesting about this business is customers are fickle. They go where they want to. They go where they find variety. They go where they find good pricing. They go where they feel they need to. That's the digital economy. You don't own a digital customer. That customer goes where they want to. It's a flick of an app. It's a change of a web address. What we have to do is we have to make sure that we are good at what we do. We have to make sure that operationally we execute on what we do well, and that keeps customers. But again, your customer stays for as long as you do your job properly. The moment you slip up, or the moment you don't have the variety, or the moment somebody else has a restaurant or an outlet that you don't have, off they go.
Thanks for that insight, Mr. Reed. I mean, you spend a lot of money getting customers on your platform and they transact on your platform in the millions. I mean, just on delivery charges, if you're charging 9 Rand and it's costing 30 plus and it may not be your exact cost, you're doing a few million orders, you're probably putting in, I don't know, 40, 50 million into customers every month in terms of absorbing that delivery fee. I mean, that's not small change.
Yeah, again, I'm not going to speak to the exact numbers or the approximation of numbers because that goes to the essence of our business model, and we're absolutely happy to discuss this in great detail in the in-camera hearings that are coming up, I believe, in February.
I'm just saying, I mean, this is not, your delivery fee is there, but you're investing a lot of money to acquire customers so they will transact on your platform. And for that reason, restaurants are saying to us they need to be there.
Yeah, again, I mean, I hear the question. I think I have already answered it, but I'll try again. Restaurants, and I don't know which restaurants you've spoken to. If you're talking about within the COVID environment, which I mean, it's the timing of the hearing is somewhat unfortunate because it seems to be clouded a little by what's happened during COVID. But now that outlets are open, outlets have the ability to attract their normal customers, be it on sit down, be it on takeaway, be it through their own delivery mechanisms. They don't have to be on our platform. We're trying to create a valuable platform, and we market to create that valuable platform because we want to attract customers, because customers are good for the platform and good for the outlets. Do we spend a necessarily high amount of money on marketing or else to attract customers? I think if you would actually look through, and it's difficult to get this because international norms are difficult, but there are listed delivery companies. The number that we actually spend on marketing is not exorbitant in any as a percentage of revenue, because I think that's probably a relative way to look at it. It's not a particularly high number in context of other businesses. And again, we're trying to attract people, and one of the dynamics of this business is highly competitive. So we're trying to attract people away from their different choices that they have. But again, I don't believe that the marketing money that we spend on the platform is out of line with norms.
Well, it depends what one calls the norm. I mean, this is what I want to have the discussion with you, and I'm glad you're here for this discussion, is exactly the different business models. And let me just sort of take you through the sort of thought process. I mean, there were other localized platforms that existed in urban areas, but with an aggressive push with the marketing budget, and it may be the norm against some big online players globally, but I'm going to question whether that should be the norm. I mean, without fail, everyone has said, we simply cannot match this. You cannot match the spend that's coming out of Uber Eats and Mr. D and their closing shop, because whilst you're in this aggressive growth phase, the consequences are that there's casualties out there. I mean, you see it. So let me put it to you. I mean, it seems a natural consequence of your business model that it will push out those local platforms where they compete head to head, and we've seen it in the market.
Look, I think so again, I think it's a difficult thing to try and understand why a business fails, because the easy part to say why a business fails is to blame it on your competitor and say they're spending too much marketing. I mean, I don't know whether the efficient dynamics that existed within that business? Were they providing the right type of customer service that people wanted to get on? Did they manage to get the right brands within their platform to actually make the business work? There are a variety of factors that play into business failure, as opposed to blaming it on your competitor. I think it's very easy to blame it on a competitor. Simple way to go. Again, I wanted to reiterate that I do not believe in, when I say norm, okay, I'm talking about norms within, effectively this country, norms that we've seen in how we've built businesses within this country, and norms within the percentage of marketing spend that happens in a business like ours as a percentage of revenue. So, it's not out of those norms, and I think that's pretty much all I can say.
Oh, look, I mean, you've had the benefit, and you wouldn't have necessarily watched yourself, but you would have heard of listening to some of the smaller platforms. And unfortunately, we've had a few challenges with Eskom to get some of them on the platform. But, I mean, even just this morning, Mr. Zondi basically said, I mean, when it's 50% off for the whole week, how on earth do you compete if you don't have the same backing? And he doesn't blame the consumer for going, but if I could get it half price on Mr. D or Uber Eats compared to Mr. Zondi's platform, I mean, it's a no-brainer. So I don't think it's complicated, personally. And as I said, this is a consistent message. I mean, it's natural for the customer. I mean, why wouldn't you? I get an offer from you every week. That's just me.
Sure. So let's talk about the local competitor. So the local competitor, is got a smaller capital expenditure, requires less funds, and can also, frankly, go and raise funds if they require to compete in a market. We started off as a very small business initially, and we raised funds. That's what you do to build businesses. I don't think that's rocket science in a business perspective. You've got to raise the funds to be able to create your business. And if you've got a compelling business and business model, and you have credible management and you show success, you'll find investors.
Look, I mean, certainly from our interactions with some of the Venture Capital Association members last week, but also some of the individual businesses. I mean, it may be that if you're historically disadvantaged or women, that it's darn hard to get funds. And many of the small platforms that we've had come to us in this time are ones that have innovated in township areas out of the, I suppose, shadow of the big delivery groups. But I mean, even our Venture Capital Association accepted that one of the questions that's going to be asked if you're raising funds is, who are you up against, and are you going to make money in the end? So it's going to be a lot more difficult, I think, to raise funds if you're saying I'm going head to head with Mr. D.
Yeah, so it's not only going head to head with Mr. D, there are various competitors that they have to go up against. When we have to raise funds, we have to raise funds, or we have to justify our budgets going forward, we have to go through exactly the same things. We have to show where we're going, how we're doing it, and who we're competing about, who we're competing with, and is someone going to put $1 with us or $1 with somebody else?
Yeah, but I think as your parent company accepts that they're a patient investor, willing to go for the long haul and willing to invest in loss-making businesses because it's the prize at the end. That's what you're going for.
Yeah, patience is an interesting one. So I've already gone through venture capitalists investing in our business, and they appear to be patient, and then they look at things, and it really depends on execution at the end of the day. So patience is a factor of execution against milestones. It's also a factor of sustainability. There are stupid investors out there who will plow money into unsustainable businesses. I can't defend that. As a business, again, we're trying to build something sustainable. We spend our money wisely, and we spend it so that we can add value to the platform. When we come back to the value add within the platform, I think we can't ignore the value add that this platform has in the South African economy. We're a truly South African business. We've contributed, I've already gone through the base slides in my presentation, a number in fact, thousands of employment opportunities for various people. And we've also provided the outlets the ability to trade and enabled the outlets. And we've enabled small enterprises. Each driver partner is a small enterprise, and they're able to make a living out of it. And franchisees are building their businesses on the top of our business as well. We're an enablement platform, and I think that can't be missed.
And I would expect that your investor is a rational investor looking for return. So, I mean, that's what I would expect. Maybe they're not, but let's go on that assumption, which means despite the losses you're making and the massive subsidies into delivery fees and promotions, at some point you've got to be sustainable. At some point they want to see that dial from red to black and break even, and then making profits and recouping the losses they've made over years. So, I mean, in essence, that means that some of the pricing's got to change. And you may see some scale efficiencies, and I'm sure your unit costs may come down, but some things like driver fees, I mean, it's difficult to see how that is going to substantially change, given that's more of an inflationary item. So it strikes me, at least, that revenue's got to go up. I mean, maybe if you want to answer that.
So it was a multifaceted question. Perhaps if you just, I think I can answer. There are a few things. So first of all, yes, I can guarantee you our investors are rational investors. That's one of the points that you put to me. The second part of this is sustainability is going to require a couple of things. It's going to require additional scale, and we don't know how big the market is. That's the fact. We actually don't know how big the market is. These businesses also, they morph over time. So you may start a business looking at doing one particular thing, and it changes into something completely different. That happens in our industry. And when I talk about our industry, I talk about internet in general. There are many cases in the world where people have started in one place and gone another place. Will the investor require a return ultimately? Of course, because they're a rational investor.
And what we've seen over the last few years is that the commission fees that Uber Eats charges its outlets tends to go up every year. I mean, this is certainly what we're told.
I can't speak for Uber Eats, but the one
Sorry,
thing
I meant Mr. D. I apologize.
No problem. So let's have a look at the model at the end of the day. So we have to become sustainable. But there's a limiting factor in all of these things, because if you don't have the outlets on the platform, you don't have the customers, you don't have a business. If you outprice yourself to the outlets won't be on the platform because it won't be worthwhile for them to be on the platform, and therefore the business won't exist. So there's a limiting factor in that all the time. I mean, this so-called perception of reliance on our business, I find fascinating, because it's just not true. The restaurants or the outlets may have been somewhat reliant over COVID. One swallow does not make a summer. Okay. The current state is that their revenues are earned from various sources, of which we are a minority source.
I can tell you that the national chains do tell us, and that's national chains who might have even their own delivery, are dependent on you. And this is a more recent communication that is not level 5 or level 4 lockdown. I mean, the most interesting response we had was, it's a bit like dealing with a drug dealer who brings you in at a low price and then slowly squeezes and ratchets up, and that the increases are not negotiable. So it may be that you negotiate it up front, but as the sort of creep happens, that is a non-negotiable element. And so I'm going to put it to you, I mean, the model of getting this back to sustainability seems to rely quite a lot on bringing revenue or more revenue in from businesses.
Yeah. So first of all, I think it's a unnecessary and unfair categorization that you've put to me on our business, and unnecessary in this type of hearing, which I thought was a somewhat an inquiry into a market and a fair process. So that's the first point. The second point to this is that this business model is almost self-limiting. Again, I put it to you that the restaurants or the outlets are not dependent on our business. And if you can show me evidence to the contrary, we can definitely discuss this in the in-camera hearings in February, where we can go through more detailed numbers as such. But they have many options, and they're not reliant on us. So they're able to go wherever. Our value in our platform is to continue executing at a high level, making sure that people are happy with what they're getting as a service on the platform, keeping variety on the platform, okay, and keeping consumers coming to the platform.
And I agree, the value is you bring consumers, and that's why restaurants feel dependent. But the other way that you're looking for revenue streams as well is the advertising, the sponsored ranking, the merchandising, I think you called it, parts that has become another part of the platform in order to buy visibility.
Apologies. Is there a question there?
No, I'm just stating that commission fees is one, but the other is advertising. I mean, you had that in your model, and I perhaps suppose as you put in your slideshow, I mean, if you look at your revenue, 79% is coming from the outlets and 21% from consumers in terms of delivery fees.
Sorry, was there a question there?
No, I was just stating it as a matter of, I suppose, fact. But if you want to respond, you're welcome. But it seems that, most of the revenues are being derived on the restaurant side of the market.
And the outlets are getting the greatest benefit out of the platform, because they're getting access to consumers, and that allows them to get additional revenue. And the fact is that they're only paying in large part, because 75% of that is commission based on a concluded transaction.
I mean, I just want to contrast the business model. I mean, the impression I'm getting from this sort of business model, and it's in fact many, to be fair, online platform models, is, I think as Mr. John put it, whoever's got funding can buy the consumer. Once you've got the consumer, the businesses have to be there too. Yes, the businesses have to be there in the beginning, but they're not paying anything to be there in the beginning. It's just whether they only pay if there's a concluded transaction. So they're happy to get on your platform. But once you have got the consumer and you're now looking to, I suppose, reach that sustainability point, the option of dropping the consumer side is not really an easy option, because that's what draws your outlets on the other side, and so the revenues tend to creep up on the outlet side, and those outlets get squeezed a little more to keep this almost cross-subsidization model in place. So maybe you can comment on that. That's what I want to explore with you.
Again, you're coming from the premise that there's some sort of dominance or reliance, and there's just no dominance or reliance here. It's a highly competitive business. We're not a subscription type business where I've signed somebody up and I've got them for a period of time, and I can eke annuity revenue out of a customer. The fact is that the customer can go anywhere. He's making a decision at every point in time. It allows other platforms to come and compete at the same time. It allows business models to morph. There are a whole lot of factors that are involved here, and I wish there were, as a business person, and I'm sure my advisors will look at me in some way to say you can't say something like this, but I wish we could own a customer, but we can't. I mean, a digital customer goes where they want to.
Yeah, and I think we had this discussion before, but that's why you need to spend money to make sure they come to you. And that's why you need to put in the marketing spend and other aspects. But once you've got them, because they are coming to your platform and they are making an order, if I'm not there, I'm not part of the decision. And that's why the businesses have to be there. So I'm just putting to you, I mean, if you look at your sustainability model, when you reach break even, where is the balance of revenue going to lie? Are delivery fees going to be at the cost of actual delivery, or are they still going to be below that? And if they are in your break even, someone's paying somewhere else. They must be.
You're assuming that the model doesn't morph over time. Things change. These types of models, that's what happens to them. Many of the models, again, that started off in certain places didn't end in the same place. They found ways to actually succeed. If you have a look at the platform as such, the platform is only valuable while you've got outlets on it, because that attracts users. If you start leveraging the outlet too much, the outlet goes, because it's not a feasible option for them anymore. And the one thing that we must understand is that digital platforms are not going to take over the world. There's going to be bricks and mortar, there's going to be digital, there's going to be stuff that I don't even know about that's coming soon that we'll compete with. I think your assumptions right now are somewhat theoretical and simplistic in that you're assuming that there's a certain status quo and that'll remain forever, and that status quo is that digital will dominate the world. I don't believe that actually happens.
Digital may not dominate the world, but there's going to be a lot of transactions that are going through a digital channel. And if you're going to access those transactions, then you need to be on a digital world, and whether that's on a platform or your own, and that's the debates we're having in this inquiry. The extent to which there is reliance sometimes on the platforms or not, and it may be that it's not in certain cases, but the fact is that. I mean, this was a discussion I had with Mr. John as well. I mean, there are certain customer journeys that end up on a digital platform, much like there are certain customer journeys that end up on a delivery, not an eat-in or eat-out option. So what I want to explore are the different business models as we sit with them. And I don't think it's that theoretical. I mean, what we are seeing is that, as I indicated to you, that commissions go up. You do need to be sustainable. This seems to be the pattern at the moment. Maybe it'll change, but that's certainly the evidence that we have at the moment. I just want to, pick up your other thing. You highlighted in your presentation there is a different model. There's the national model which you're following, and then there's the local offering. And we've heard about some of the local offers, and I've also said to you, it seems that when they do come head to head, it's tough to survive. You may disagree. But the striking feature that we're starting to see from the local offering is far lower commissions, typically non-discriminatory commissions as well. They may charge delivery as it is, or they may choose to invest, but they're not always got the kind of backing and funding to invest. And I think, as you even put, maybe more finding other ways to market, grow consumer awareness, and even convert. And what we have in the inquiry, I suppose, identified is in fact there's many entrepreneurs opening markets where yourself has not gone in the past, in townships, and finding ways to do that without the kind of funding, but a much lower fee. Now that does seem to be, an alternative to the national business model, as you put it. And I suppose my question is, that model has a lot of attractions too. And there are entrepreneurs doing that and opening spaces. They're also bringing shops on board. They're also employing drivers. They're also doing a lot of the things that you're talking about. But it also starts to look quite attractive from the kind of outlet perspective. So, if we had to look at these two different business models, I'm interested in your perspective, because I'm seeing the national model bulldozing over the local. That may be wrong. You may tell me that they'll survive and they'll live side by side. But the question I did want to ask, is there space for both? And does the local offering actually not look quite attractive? At least if you're an outlet or a consumer potentially.
It's difficult for me to answer any of these questions because you're asking a perspective from a particular business model which we don't actually operate. The one thing that I can probably answer is, do I think that the local models can survive and provide a differentiated type of offering to a consumer? Absolutely. People build models in different ways and they find ways to make them work. That doesn't mean to say that the one model is wrong and the other model is right.
But at least, where those models have gone head to head with you, they haven't necessarily survived. As you now have told us in this presentation, as you move into townships, are they going to survive with the kind of marketing budgets and promotions and delivery subsidization that you have?
I don't have a crystal ball on this, but this is one point that's for me is quite a difficult one to answer, because this is almost damned if you do and damned if you don't. So do we move into the townships? Absolutely. If we don't move into the townships, we are accused of being exclusionary. Okay, if we do move into the townships, we're now being accused of bulldozing over smaller operators. So it really is between a rock and a hard place, yeah.
No, I'm with you, and that's why I wanted to have the discussion with you, because as a panel and the inquiry team, these are the kind of issues we need to grapple with, and we don't want to just get the perspective of a township entrepreneur. We also want to get the perspective of a Mr. D, and it's not an easy debate to have, and that's why we wanted to have it with you.
The points on us moving into the townships, which we already have in many regards, there are also benefits for us moving into those townships. We actually enable outlets within those townships. We enable drivers and driver partners within those townships. We enable franchisee. We've got franchisees who have started in particular townships to actually enable delivery. So there are many advantages to our model going into the townships as well. As I say, I don't think there's a right and a wrong answer here. I think the question of will one business survive or not is something we all have to wait and see. Any business that does its job well should survive. And again, building a business is a lot of hard work, and there's a lot of luck involved. I can't speak to the second part. You also got to be lucky.
Yeah, look, I would disagree with you on the point that any good business should survive. I mean, as I said, the reason that we're having this discussion around the budgets and the marketing and spend and funding is because those businesses saying, I'm outgunned. I suppose from a panel's perspective and even an inquiry's perspective, we're not just looking at the benefits that may accrue to Mr. D. If there's a different business in there, it might also have delivery drivers, as we indicated. It might also invest in those communities, and the kind of social benefits may be the same. I suppose what we need to also be cognizant of is there needs to be space in this online world for other entrepreneurs as well. We need to ensure that competition remains and it's a contestable market, and that's why we're looking forward. And we may all not have a crystal ball, but we need to do that as best we can. And I'm sure you're aware of that from the panel's mandate, and the inquiry's mandate is precisely to look at how do we ensure that these remain contestable, how do we ensure there's space for entrepreneurs, and not just large commerce, but also smaller and also historically disadvantaged as well. So that's why we're interested in it, and that's why we need to ask these questions. I just want to, under the hypothesis, let's call it that business model national wins out. And I know it's an hypothesis because you don't have a crystal ball. It seems that there will be different outcomes for at least outlets and potentially consumers. For outlets, your model is a high marketing spend, higher commission, compared to the local business. For the consumer, you get promos and good deals and maybe subsidized delivery. But what we're also starting to see, it seems from reading the articles, is restaurants start to put up the menu prices as well. Maybe not to cover all the commissions, but there may be a balance between getting a great price when you're on promotion and maybe out of promotion, potentially a slightly higher price. And that's in contrast to, I suppose, the hypothesis of local wins out or remains, where there's a lower commission fee and maybe less incentive for the outlets to push up menu prices. I just want to get your response to that.
Yeah, I don't know if I'm bright enough to answer that, to be perfectly honest, because it has so much complexity in it that it's difficult to answer. You've made a number of assumptions which I can't verify or not, and I think although you've put it very succinctly, I think that the models are much more complex than that. This understanding that the local model, at what stage does a local model need more money? At what stage does it need higher commission rates? At what stage does it need to invest capital in its infrastructure to handle local scale? I can't answer those questions. So it really, I'm sorry, it's just too hypothetical for me to answer.
I'm giving you the opportunity, and as I said, it's not that hypothetical. In your own presentation, you talk about the two. So I'm just saying the one clearly has a national approach, more capital, more complexity, more infrastructure. The other one not. There are benefits, no doubt, to you being a national offering, and there may be benefits to the local offering. So I'll give you another opportunity, if you want to respond, that depending on what happens here, there may be different consequences for consumers and outlets, and would you at least accept that?
No, I can't accept that because I don't know what the outcome is. So ultimately, you're going to get a consumer trading on a platform, and I can't tell what that outcome is. Again, I just don't have a crystal ball to be able to tell you.
I mean, we were made aware, I suppose, earlier by RASA that certain places had put caps on commission fees. I think this was temporary in COVID, but as I understand from my team, that places like San Francisco have now made that permanent, so 15% cap. New York City has a similar bill. I mean, I know you feel that any intervention is not appropriate at this time, but I would like to ask your perspective on those bills and give you a chance to say how that might affect your business model, just so one can understand it.
Sure. So I can't speak to the cap in the different countries. I did actually listen to the RASA hearing, and I would be surprised if the numbers mentioned in that RASA hearing are correct. We can have a look and see what's happening elsewhere in the world, and we can have this discussion in February. What I can say is that intervention at an excessive level will probably make the business model unsustainable, which will have effects throughout the model. It'll have direct effects on the participants in the model, and you've seen the participants in this model.
Yes, I don't think, as I said, my team has only found, at least subsequent to Mr. Albert's coming, so it's obviously not an extensive search, but a 15% cap. But that's what I wanted to ask you as someone who has commission fees that are higher than that. How would this disrupt your model, and how would it make it unsustainable?
Yeah, so again, the commission fee structure we can discuss in February. As we've already said, we've said that's confidential, and the matters related around that are confidential. What I can say is this is not a one size fits all. Models develop and they morph over time, and I don't know where this model ends. To be perfectly honest, I really don't. When you start a business, you have something in mind, and things change. I can tell you that. When we started Take a Lot, what Take a Lot is today and what I thought it was going to be are two very different things. So it's really very difficult for me to answer that.
All right, I thought you would have welcomed the opportunity to explain, and that's partly why I appreciate having the business people here who can talk to us about whether this would upset the apple cart irreparably or not, because at some point we've got to explore these issues. We haven't made any findings, but I thought it would be interesting just to explore this. I mean, obviously they've gone ahead. That may be a disaster, it may be challenged, but I mean, just thinking it through, by capping commissions, does this not force competition on other fronts? Because there's so much revenue that you can get from the outlet side of the business, and therefore either you need to charge consumers or you need to become more efficient at delivery, so that if you are recouping it, that a lower delivery bill works, and that's a point of competition. But it seems at the moment there may be competition on who's got the biggest funding. Might this change that dynamic?
Well, capping commissions will certainly have an effect on the business. We can't deny that. but again, it remains a highly dynamic environment and competitive environment to date. You are competing with not only the likes of the players who are the likes of, I mean, let's mention them, Uber. You're competing with many people and many new entrants that are going to come into this particular market. And I think just going back to a point on looking at other markets or other countries to inform these types of things, I think we've got to be very careful to have a look at that as well, because it really is a different stage, it's a different model, it's a different country, it's a different scale. There's a whole host of differences in country dynamics. If I look at, for instance, Indian e-commerce versus South African e-commerce versus Romanian e-commerce, I mean, they're very different places. They have different input costs, different ways of doing things, different dynamics.
I mean, the other thing in the New York City bill, and it is only a bill at the moment that struck my eye, is that restaurants should get access to customer data as well. So it's not just about a cap, but it's also access to customer data.
Are you asking me whether I agree with that or not?
No, I would presume you may disagree, but I suppose, yeah, I mean, my question may be, and I don't know the rationale at the moment for that approach, but we get a lot of restaurants saying that they would like the customer data. But it strikes me, certainly in our limited discussion in e-commerce, this might be a way to also reduce dependency on a platform and, in fact, provide those alternatives to a greater extent. I don't know what your view is.
Well, I find it a very interesting view in that, you spend money to build a platform, and then you effectively encourage free riding on that platform and give other people the benefits of the platform that you've spent money to try and create value out of. And it's the customer data is such, besides Poppy and all the rest, which is another complexity that comes into it. Is the platform's data that they have marketed and gained customers to the platform. The customers that come onto the platform and buy from the outlets are not necessarily the same customers. Some of them are, but they're not necessarily the same customers that go and buy from those outlets on an ongoing basis. So what makes that data theirs?
Well, and that is the debate. I mean, what is the real extent of free riding possibility? So that's the one question. So outlets without a delivery option themselves, and there may be many, this may be a channel to also attract an in-dining experience. But for many customers who want the delivery experience, they're maybe going to still sit on the platform. I mean, the other question that has been raised in this is, I mean, does it not require then that the platforms show its value to the customers, and if they're not offering that value, then the customers might go elsewhere. So it does, in a sense, add another pressure onto the platform to ensure it is giving value to all sides.
Sorry, I don't understand that statement. When you say the platform has to show the value to the customer, what does that mean?
Well, I suppose if the restaurant's saying, look, come pick it up, and it's at a better price, then the customer's got to weigh up, well, Mr. D gives a great delivery experience, or I could get it slightly cheaper if I went and picked up from the restaurant, because they've told me about the difference now, because I've been contacted. Yeah, I've got to assess the value that Mr. D is providing in terms of that great delivery experience against the price difference. And being informed on that ensures that the value of the platform is there for the consumer. So maybe you can just discuss what's the realistic extent of free riding and respond to the question about platform pressure.
Sorry, so the extent of free riding on the platform, are you Sorry, I'm sorry, Mr. Hodge. Can you just break up the question because I actually don't understand. There are two parts to this question.
So the first question is how realistic that there is extensive free riding on a delivery platform, because many of the restaurants may not have their own delivery service, they may not be able to execute as well as you. So that's the first question. The second is being presented with the options, because the restaurants can actually market to those actual consumers. Does it have a beneficial competitive effect by ensuring the platform shows its value if it's going to be more expensive?
So the first one, difficult to answer because I have never experienced this, so I don't know what extent of free riding will happen or not. Um, it's an experiment which I haven't seen. The second one on the benefits of the platform, I think there are two answers to that. The one is that the benefits of the platform effectively are in what the platform delivers to the customer. The customer is not a stupid individual. They're smart customers. They're digitally savvy, and I can certainly tell you that in some of our other businesses, people are looking at pricing in store, online. All the rest is a highly competitive environment, and it's exactly the same with food delivery. I'd be surprised if customers don't know, because we've actually seen complaints come through on this in this regard. So I think you're assuming that the customer doesn't know, and I'd probably like to see some verifiable data that actually shows that.
Can I just ask on your delivery drivers and franchisees? I just want to understand this relationship, because I don't think I'm clear at the moment. You've got franchisees, and as I understand, or at least I think I understood, that they have a relationship, with the drivers. So as I understood it, you've got 40 franchisees that run delivery zones, and because they're running the delivery zone, they're running the drivers in those zones. Is that how it works?
Correct. So we conclude franchise agreements with these franchisees, and they're entitled to specific delivery zones. And effectively, their job is to make sure that be it, and it's a multi-dimensional thing. So be it a take lot package, or superfluous package, or a food delivery, they manage that using our technology that we provide as part of the franchise agreements, and that we develop all the time to make sure that they're able to do their jobs. And they then have independent drivers. To the most part, some of them have drivers that are directly employed by them, who then deliver on their behalf. There's a payment that gets made to the driver for the delivery, and there's obviously the payment gets made from Mr. D Food, or the Take Lot delivery team as such, to the franchisee, and the franchisee pays the driver.
All right, because that's what I understood. I mean, you don't have a direct relationship with the driver. It's through
No,
the franchisee.
Correct. I mean, we have direct relationships with some drivers who drive trucks and things like that, but not the drivers that I'm referring to here.
Yeah. So I mean, that was my understanding, and I'm glad you clarified that you pay to the franchisee, and they then pay the driver, presumably. And is that on a sort of per delivery type basis? I mean, you've got the employed, but then you've also got the contract.
Correct. It's on a per delivery basis.
So when you talk about the sort of what you've done for the drivers, I just wanted to understand that, because that's what confused me. I mean, as I understood, you didn't have a direct relationship, and you had a slide where you talked about COVID drivers funds, keeping them safe. I mean, so who is that? You or the independent franchisee?
The COVID fund is us. We put a fund in place to assist the drivers at the time during COVID to actually pay them directly. So we paid that money onto the franchisee, and the franchisee paid it onto the driver or in fact, Alex, did we pay directly or not?
No, we paid to the franchisee.
Yeah, so we didn't pay directly. We paid via the franchisee to the driver. In fact, if I recall correctly, there were lists that were put together on drivers who were affected, and we continued, administering those lists and paying the drivers. So that's a cost to us. Then there's additional things. So what we do is we facilitate. So we facilitate. We'll go to a particular outlet and we'll say, right, here's a scheme that we would like to put in place, which the franchisee is going to roll out to the drivers. Let's negotiate decent rates around leasing of motor vehicles, and as well as the maintenance of those motor vehicles. So we'll go and we'll facilitate that arrangement to the benefit of the franchisee and the driver. The same with the helmets. In some cases, we'll subsidize the franchisee to be able to provide that to the driver. In other cases, the franchisee will do that. If we look at during the COVID period, there was hand sanitizer and all that type of stuff that needed to be supplied. We went out and bought hand sanitizer for everyone, delivered it to them to make sure that people were safe during this time. So, but the primary relationship is that of an independent driver in most cases with the franchisee, except in exceptional circumstances like COVID where we stepped in.
All right. So I mean, just so I understand your slide here, you, on things like motorbike insurance, etc., you go and agree rates because you've got buyer power. Presumably, you probably won't like that term. So to say, large buying potential, you can negotiate a better fee, but the franchisee would then use that insurance for the drivers. They'd pay the insurance. Is that right?
Well, they'll actually, the driver may end up actually paying the insurance, but the benefit that's been negotiated, and the buying power thing, I don't mind the term so much. I think maybe you wouldn't like that term.
No, I realize some your lawyers in the room may be sensitive, so I'll take that back. But just so I can understand, because you also said, look, I mean, you saw an opportunity. Drivers at night, obviously now food delivery is happening at breakfast and lunch too, but maybe not on the same scale as dinner, and parcel delivery in day. So, I mean, what proportion of your drivers are employed as opposed to contract?
No, the majority are contracted.
All right. And your COVID fund, I mean, did that apply to contract as well as employed?
Absolutely everyone. Well, in fact, in this particular, so when you look at the majority being contracted, the majority of the benefit of that COVID fund would have gone to contracted employees.
Another thing that got raised earlier today with another delivery is this point of sale integration, and so I just wanted to understand this a little better. I mean, as I understand the original model, people were given a tablet, or I think you showed us Android device, which seems more like a smaller handheld device rather than a bulky tablet. But it seems you can, at least for the bigger chains, you have, I suppose, a point of sale system that's common across all of their outlets. There is the possibility of integrating into that point of sale. So you can, I suppose, orders come up on their normal system rather than on a handheld. So I just wanted to understand a little better, the extent to which this is happening. Is this quite difficult tech given their point of sales, or is it not? Is it just, I mean, we hear about all the time we heard on Play Stores and things, there's APIs that you just link into and extract data. So maybe if you could just give us some insights. Obviously, if there's confidential information, don't traverse it.
No, look, I mean, sorry, I had to chuckle when you said it's just an API because I think that's the impression of most people when it comes to digital, and it may even been my impression when we started this business that everything was going to be an API and was just cut and paste, but it's not the case. So point of sale integration is actually quite complex. It's not that easy. And the larger nationals have requested certain point of sale integrations. I think we've done one point of sale integration so far. Let's not mention the brand, but
we've got two at the moment.
Two point of sale integrations. It's not something that we've managed to roll out en masse. It takes quite a lot of technical work on our side, and we're although we're being categorized as a behemoth, we're actually quite a small business in this business, and a growing one, and we've got 101 priorities. And we have to try and prioritize our engineering work at all times. And, when we're able to get to something like this, we'll get to this. It's certainly not a priority for us today.
And I don't know if Mr. Vos can assist on this, or yourself, Mr. Reed, but I mean, is this on an almost... I mean, I'm not technical at all, but on an almost open standard. So trying to overcome all these difficulties, and maybe these restaurant chains never had to have an integration of any sort, but would it be on a relatively open standard, so others, the kind of solutions that are being found could be open to others?
Well, look here, Mr. Hodge. I mean, I can't speak for solutions out of the market. I can only speak to the solutions that we've got in place, and it's rather custom in that regard. I mean, it requires in detail menu mapping, because of course we may have a completely different menu structure within our own systems than individual restaurants may have, and with that, it is quite complex and not something we've prioritized widely at this stage.
Yeah, because I think the reason I've just wanted to explore that in part is, we're seeing in at least other platforms that sometimes there is an ease of transferability of data, and we heard about in travel accommodation about multi-platform listing softwares. I think when we come to classifiers next week, there's also listing softwares that happen, but maybe delivery is a little more complex than those situations.
Yeah, I think the point of sale integration is not a trivial thing, and because of the variety of point of sales that are out there, I think it's traditionally always been a difficult thing to get right.
I just want to go to the merchandising opportunities that you offer. I mean, I just want to understand, are these relatively new? Because you're talking about unsold inventory, and I mean, maybe just give us some context. And also, you had highlighted 3 positions in the page, so maybe you can just tell us a little more about the 3.
Sure. So let's start with the merchandising. They're not new. I mean, we change things often to try and increase conversion. I'm not too sure when we last changed the merchandising stuff, Alex.
We introduced promotion stuff early on in the year, but merchandising itself hasn't been adjusted in a while.
Yeah. So this is, again, it's a evolving platform, and these things evolve over time. And when you get the opportunity to develop certain functionality within the platform. But at the essence of these merchandising options, there's 3 spaces. Our page 29. Sorry, I apologize to the public that don't have obviously access to this slide, but page 29, you'll see those three areas there, and those are available to purchase for anyone based on a rate card. Then we've highlighted the filters, which comes in the next one, which is basically to filter through. That's really, and again, this is all really to aid customer discovery. So the filter is the next 2 parts there, which basically allow you to filter down to what's on special, halal, or fastest, closest to you, or a particular type of food type. And then the last one, which is just the general listing page as such, which you basically scroll up to, and you see all of the restaurants that are in the vicinity of you listed from closest to furthest from you, with the differential of delivery and collect being listed before just collect.
Look, we had a discussion yesterday with Uber Eats about, I suppose, transparency on advertising. It seems they on their sponsored links put sponsored. I mean, as I understand with Mr. D, there's no such label. I may be wrong.
No, you're correct. And to be honest, we watched the Uber session yesterday, and as a customer centric organization, I think there's a point there.
All right. Well, then, yeah, because I think I mean I did notice as a user of other Naspers products like the media products, that's also labeled as well. Um, so we'll see
Yeah,
how this develops on your platform.
it's the evolution of the platform. I mean, it's something that we definitely look into.
Just give me a moment. There's just a few areas, and I'm sorry if we're taking more of your time than we anticipate, but hopefully we'll be finished soon.
It is Friday in Cape Town, Mr. Hodge.
I know, and last week we were told that you should have a glass of wine in front of you at this stage in Cape Town. So, um, I mean, the other thing you point on the business model, you need the reputable brands, and that's the national chains. Um, and I assume you work hard to obviously get them on your platform because you think they're important. And I presume I presume you negotiate at a head office level. You're not trying to negotiate with every store. Is that right?
That's correct. I mean, we try and negotiate at where it's most effective to negotiate.
Uh, and I assume, when you're negotiating with them, it's not about getting one or two stores, it's about getting the group on. I realize there's corporate and there's franchisees, and there may be a difference in treatment. But the discussion is really about getting, I suppose, at least all the corporate stores on. Is that right?
Correct. We may try and get the franchisee stores on at the same time, but sometimes certainly from what they tell us is they don't have the ability to bind the franchisees.
And I'm sure franchisee agreements differ, but is that fairly uniform in your experience? That they can't bind them?
Yeah, I'm going to have to actually defer this one to Mr. Vorst.
No, I mean we don't have any. As far as I'm aware, we don't have any binding agreements for franchisees. I mean, at the end of the day, everything needs to, even though there may be one general agreement on a group basis, it still needs to be agreed to and agreed by the franchisee. I mean, what the corporate brands negotiate with their franchisees, we may not essentially be privy to.
All right, thanks. That's useful because, as I said, franchise agreements may differ, and some may have the power, some may not. But if your experience is that it's generally not. And I mean, the other thing you do with them is co-branding, as I understand. And what's the purpose of co-branding for your business and theirs?
Well, again, I think the brand at the end of the day is important for the platform because it creates credibility in the platform. And the co-branding agreements or relationships that are done are to do exactly that, to enhance the credibility of the platform for all on the platform.
And would there be other sort of marketing opportunities that you discuss?
I mean, sure, there are marketing opportunities that we discuss with the brands and with individual restaurants all the time. I mean, it's part of our business.
I mean, maybe just the last thing for me is we obviously had a long discussion yesterday with Uber Eats about differential commission, but
Mm.
from the press reports, it would seem it's also a Mr. D thing.
Yeah, again, we've claimed confidentiality on commissions. I think, in fairness to certainly ourselves and in fairness to our outlets, we are happy which I mean, these matters are confidential between us as well, and we're happy to discuss this in detail in the on-camera hearings in February.
And I certainly don't want to go to the details because that is confidential. But I mean, you say it's negotiable. I assume it's not uniform, and I would just say that that's what the press articles seem to suggest too.
Yeah, so we've seen the press article. In fact, I hadn't seen it till before yesterday when it was made, when you highlighted it. Again, we negotiate individual contracts with individual outlets.
And I can understand, much like Uber Eats, you're a little reticent to go too much further in this public forum.
Yeah, and again, I think in fairness to ourselves, because fairness cuts in many ways, in fairness to ourselves, in fairness to our outlets as well, and when I say in fairness to ourselves on a competitive basis, we don't want to discuss this today, and we're happy to discuss this in detail with you in February in the in-camera hearings.
Yeah, and I think the point I made yesterday to Uber Eats is, transparency does wonderful things. Um, and whilst there are individual rates that may be confidential, all I would want to put to you is do the bigger chains do better than the smaller independents?
Again, this goes to the heart of the discussion, and we're happy to discuss this in February.
And I'm sure we will. It's just a shame the public won't benefit from any insights from this.
I don't actually understand what the public would benefit from this particular discussion.
Well, I think as we discussed yesterday with Uber Eats, I think certainly transparency assists the consumer make certain choices. And I think this is becoming an interesting theme that we're seeing popping up across a number of platforms. And where the consumer has more insight, maybe they will say the platform adds the value I want, maybe they don't. But the need for secrecy, I think, is can be an injustice to the consumer.
Hodge, I mean, I need to actually understand this as a business person. My first question around this is that is there a piece of legislation that requires us to essentially disclose a confidential matter between a company and an outlet? That's the first question. The second question is that does this go elsewhere? I mean, in the same manner, should restaurants disclose their margins? Should retailers disclose their margins in the spirit of transparency?
So there is no legislation. It's a question of whether transparency would aid the consumer, and it may depend on what. So, as I indicated, I mean, to Uber Eats, I think for the consumer to know what the commission is to their local restaurant when they make a choice about delivery may in fact be empowering.
But if I like Baker's biscuits, okay, and I buy them from a retailer, and somebody else makes something else, and the one makes a different margin to the other one, should that be made known to the customer so that I can make a choice between Baker's biscuits and something else? Because I might actually need to know that. I really don't understand this premise at all.
Yeah, and I think the fact that you don't understand it maybe is you know is something that we'll take back. But maybe as a consumer in this, all I'm putting to you is maybe you should have an understanding of how the back end of a platform works, because all you're responding to is the marketing at the moment.
But again, I need to ask the question: how does that then go to a retailer or to somebody else? If I buy a car, do I need to know the margin that's sitting in buying a car? Is that part of transparency? I find this question somewhat bizarre.
Or somewhat uncomfortable.
No,
Mr. Reid and your team, I want to thank you for coming on a Friday in Cape Town to answer the questions and also present to the public and also to the panel. We will have those in-camera sessions, as you indicated. And if there are any further confidential submissions you want to make before those, as I think we've indicated to your legal team, you're welcome to do that. And then we can pick up these conversations then.
Mr. Hodge, thank you very much. And Ms. Tsepe, thank you very much for your time. On behalf of our everyone around the table right now, I also thank you for your time. And I'll see you on the 24th as well.
Yes, I forgot about that.
Thank you. Have a good weekend.